The first cracks didn't appear on a battlefield. They appeared on a trading screen. Early one morning, bond traders in New York, London, and Tokyo noticed something strange. Government bond yields were rising again, fast. Not because the economy was booming, not because growth was exploding, but because oil was. Within days of military strikes involving Iran, global energy markets jolted. Brent crude surged from roughly $70 to well above $110 a barrel as supply disruption spread across the region. And when oil moves that violently, something else always follows. Inflation fears. That's when the quietest market in the world, the global bond market, suddenly started behaving like a nervous animal. Bond prices dropped, yields jumped, and investors began asking a question that hasn't been asked seriously since the inflation shocks of the early 2020s. Is inflation about to come back? To understand why that question matters so much right now, you have to understand what bonds actually do in the modern financial system. Governments borrow money by issuing bonds. Investors buy those bonds and receive fixed interest payments over time. In theory, it's one of the safest transactions in finance, which is why government bonds sit at the center of everything. Banks use them as collateral. Pension funds rely on them for stability. Insurance companies hold them as long-term reserves. In total, the global bond market is worth more than $130 trillion. It's the foundation beneath the global economy, and foundations are supposed to be stable. But lately they haven't been, because inflation is poison for bonds. If investors buy a 10-year government bond paying 3% interest, but inflation suddenly jumps to 6%, the real value of that investment collapses. So investors demand higher yields. And when yields rise, bond prices fall. That's exactly what markets are starting to price in again. As tensions around the Strait of Hormuz intensified, oil traders began warning about a potential supply shock. This narrow passage handles roughly 1/5 of the world's oil shipments. If tankers stop moving through it, global energy markets tighten almost immediately. And that's exactly the fear right now. Some analysts warn the disruption could remove more than 10 million barrels of oil per day from the global market, the largest supply shock in modern history. Prices responded instantly. At one point, crude briefly surged close to $120 per barrel as traders priced in the possibility of a prolonged conflict. Energy shocks like that don't stay contained inside the oil market. They spread. Fuel costs rise. Transportation costs rise. Food production becomes more expensive. Manufacturing prices climb. Suddenly, inflation pressure spreads through the entire economy. That's why bond markets reacted so quickly. 2-year government bond yields across Europe, and the United States jumped sharply as traders began reassessing future interest rates. And that creates a second problem: central banks. For months, investors believed interest rates would start falling again in 2026 as inflation cooled. But an oil-driven inflation shock changes that math. Suddenly, rate cuts start disappearing from forecasts. Some traders now believe central banks could keep rates elevated much longer if energy prices remain high. That possibility is what's really unsettling bond investors, because governments are already carrying massive debt loads. The United States alone has more than $34 trillion in federal debt. Every time bond yields rise, the cost of servicing that debt increases, which means governments must either borrow even more money, or cut spending, or raise taxes. None of those options are politically popular. But the bond market doesn't care about politics. It cares about math. And right now that math is becoming uncomfortable. Higher oil prices push inflation expectations higher. Higher inflation expectations push bond yields higher. Higher yields push borrowing costs higher across the entire economy. Mortgage rates rise. Corporate loans become more expensive. Stock market valuations come under pressure. It's a chain reaction. And the strange thing is that during many crises, bonds usually rally. Investors run towards safety, but this time the opposite has happened in several markets. Yields have climbed even as geopolitical risk increases. That's unusual, and it suggests investors are more worried about inflation than recession, which is a very different kind of economic fear. In fact, some economists have started whispering a word that hasn't been popular in decades: stagflation. A world where growth slows but prices keep rising. Conflict in the Middle East, rising energy prices, and slowing global trade could create exactly that combination. And markets hate stagflation because there are no easy solutions. Raise interest rates to fight inflation, and you risk crushing economic growth. Lower rates to support growth, and inflation can spiral out of control. Central banks get trapped. That's why governments and energy agencies are already scrambling to calm the market. The International Energy Agency has even coordinated the release of around 400 million barrels of emergency oil reserves to stabilize supply. But even that massive release only buys time. It doesn't solve the deeper problem. The global economy still runs on energy, and when energy becomes unstable, everything becomes unstable. Markets, currencies, bonds, even the assumptions investors have relied on for decades. Which brings us back to the quiet panic spreading through the bond market. Because for years, investors believed government bonds were the safest assets in the world. But if inflation rises again, if oil prices stay elevated, and if governments continue borrowing at historic levels, then the safest asset in finance might suddenly look much less safe. And if that assumption breaks, the consequences won't stay inside the bond market. They'll spread through the entire global economy, which leaves one final question hanging over the financial system right now. If the world's safest assets start cracking under the pressure of inflation, what exactly is holding the system together?